Greetings, everyone. Welcome to Cutting Through the Noise, our investment webcast. I'm Samantha Geyer, Marketing and Communications Manager at Signature FD, and I'll be today's moderator. Before we get into the presentation, let me tell you a little bit about Tony and our firm. Tony Welch is a partner and Chief Investment Officer at Signature FD. He chairs our investment committee and represents the firm at various industry events. Tony's a contributor on numerous broadcasts, including NASDAQ Trade Talks, TD Ameritrade Network, and his commentary has been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. Signature FD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. It's what we call net worthwhile. If you're interested in learning more about how we can help you activate your wealth and start your journey toward net worthwhile, please visit signaturefd.com. With that, I'll turn it over to Tony to get us started.
Thank you very much, Sam, and thank you to the listeners for tuning in with us this quarter. So here's what's on the agenda. We're going to start out with a bit of a Q1 recap and really expand it to the total economic and market cycle, and hopefully we'll paint a picture of where we think we are in the grand scheme of things today. Then we're going to spend a little bit of time on corporate earnings. Earnings are really this so-called mother's milk of a market cycle. And finally, we'll spend a little bit of time on some election year perspectives for y'all. So let's go ahead and kick things off with the cycle. So many of you may be familiar with this graphic because I've shown it in a lot of these presentations. In the top clip here, it shows a stylized representation of the average stock market cycle. And the bottom clip shows the economic and corporate earnings cycle. So reading this chart from left to right, we can see that historically, what you've gotten is you've gotten a bear market that coincides with an economic contraction or a recession. And that's precisely what happened in 2020. Then you get a very strong but short bull market that goes along with the initial economic recovery phase. That did, in fact, happen from late 2020 through 2021. Now, that tends to be followed by a second follow-up bear market as the economy downshifts from a rapid recovery to a slower but more sustainable rate of growth. And we got that bear market in 2022. Now, when the dust settles and recession risk seems to be fading, the market has tended to settle into a longer, more sustainable bull market advance. And that's where we think we are today. We're in the middle of that longer, sustained bull market advance. Now, these bull markets have typically lasted until right around the onset of the next recession. So looking at returns from 2023 and the first quarter, they're very much in line with this sort of cycle progression from the previous slide. All major equity categories gained in 2023, and those gains carried through to the first quarter of this year. Large cap stocks were up nearly 11%, but even international stocks and small caps had solid quarters. And that's despite bonds being down a little bit in Q1 as interest rates moved higher throughout the quarter. Now, rates were higher because inflation has been stubborn and economic growth has actually been accelerating somewhat. We'll talk about those variables here in a minute, but the big picture is that this has been a bull market that began in October 2022. And the data from Q1 is in line with a continuation of that bull market in stocks. Now, a great question might be, how long can this bull market last? Well, a couple points. First, these second bull markets of an economic cycle, they've tended to run longer than the first bull market. So if history is a guide, we might expect this one to go longer than the bull market of 2020 and 2021. Now, second, just in general, this has not been a very strong or long bull market of yet. The black dashed line in this chart, that shows the average gain on the y-axis and the average amount of time on the x-axis for bull markets through history. Now, the black dot here on the chart shows the current bull market. Now, note that the average bull market has tended to last longer and deliver greater returns than what we've seen so far. So this is really just for historical context, but I think it does a good job illustrating that this bull market has not been overly long yet or overly strong as we stand today. Now, I noted that the secondary bull markets in a cycle tend to take you to the next recession. So let's take a look at some of the economic developments. Now, there are some reasons to be concerned about the economy, but if I'm being honest, there's always reasons to be concerned about the economy. This is an enormous and dynamic economy, so things will never be perfect for every economic sector, business, or individual. But on net, the punchline is that the economy is in fact growing, and it's doing so at a relatively strong rate. And the data has been surprising to the upside versus economist estimates. So the red line on this chart plots a calculation from the Atlanta Fed that they call GDP Now. It takes all available real-time data to form an estimate for economic growth. You can see that their estimate has been very steady in that 2.5% growth range. Now, that's pretty solid growth for the U.S. economy. And the blue line shows economic surprises. Now, when that data is above that dashed black line, that means that incoming economic data is beating the forecast. And that's largely been the case for over a year now. So economic growth is being led by consumer spending, but we have noticed that investment has also seen some pickup as well, and that's a good sign. Now, interestingly, the economic expansion seems to be broadening out here in the first 3 months of 2024. Some cyclical areas of the economy, like manufacturing and housing, have shown some signs of life recently. Now, here we're showing two different data providers' calculations for the Manufacturing Purchasing Managers Index, or PMI. Now, any reading in this data above 50 means that the manufacturing sector is expanding. And we can see that after facing some headwinds in the Fed's rate hiking cycle, manufacturing seems to have returned to growth of late. This is a good development because the more economic sectors that are participating in the expansion, the more sustainable the expansion is likely to be. Now, economic growth certainly helps companies to grow their top-line sales, and then profit margins help to determine how much of that top line makes it down to the bottom line earnings. And there's some good developments here for profit margins. The single biggest line item in most companies' expenses are labor. So let's take a look at recent developments in the labor market. In short, the labor market is still normalizing, which is helping us to take pressure off of wage growth. Now, the blue line here in this chart, that shows the number of job openings relative to unemployed individuals. And the orange line tracks the Atlanta Fed's real-time wage growth tracker. Now, note that as job openings have been normalizing, so too has that wage growth. That's helping greatly with companies preserving their corporate profit margins and even expand margins of late. So to start the year, one of the reasons that interest rates are up is because inflation has been quite stubborn in the first quarter. But we do not expect a big inflationary resurgence here. The reason is because of that normalization in the labor market that we just showed. Traditionally, if core inflation, which strips out volatile food and energy prices, is going to reignite and move higher, it needs to be supported by higher wage growth. But what we're actually seeing is softer wage growth, which should work to bring core inflationary pressures down over time. Now, in this chart in the top clip in blue, we're showing average hourly earnings, and we're laying that on top of core inflation in the black dashed line. There's obviously a strong correlation between these two data series. And because market participants know this relationship exists, we have a good grasp of how it's going to affect Fed policy. Now, we don't know when the cutting cycle will start or how many cuts they will do because inflation can be very noisy in a short period of time. But we do believe that at a minimum, the hiking cycle is over. And what that does is it allows investors to turn their attention from these changing macro variables like interest rates and put more of a focus on corporate fundamentals. So last year, earnings were negative through much of the year. The bull market was being driven by valuations. In other words, valuations were getting more expensive while earnings were contracting. Now, that is not uncommon in the first year of a bull market. Here in this chart in blue, we're showing the average price to earnings ratio around bear market bottoms. Note that stocks do tend to get appreciably more expensive in the first year of a bull market, and that certainly did happen in 2023. But eventually, corporate earnings turn higher, and that works to support the continued bull market. So what we're showing here in the bottom clip in red are corporate earnings around bear market lows. And that's what we think we're in now, is valuations got us the first leg higher this bull market, and earnings need to take us the rest of the way. So I noted that profit margins get a tailwind from softer wage growth, but there are a lot of other factors that go into the overall earnings backdrop. Fortunately, our partners at Ned Davis Research have a very robust model that describes the attractiveness of the economic environment for corporate earnings. So here in orange, they've combined 12 different economic indicators to form this earnings model of theirs. Note that it bottomed in the summer of last year, and the environment has begun to get appreciably more attractive from an economic perspective for companies to grow corporate earnings. Now, we expect 2024 to be a pretty good year for fundamentals. Now, one thing we don't want to do, however, is to be complacent, especially about market segments that are very richly valued. So here we're showing the price to earnings ratio in blue in the top clip and the price to sales ratio in orange in the bottom clip for the so-called Elite 8 stocks. Now, the Elite 8 is comprised of Apple, Meta, Microsoft, Tesla, Amazon, Alphabet, Netflix, and NVIDIA. Now, these might be terrific companies, but they're also very richly valued. We have about a neutral exposure to these 8 companies and client portfolios, but our partners at BCA do remind us the cautionary tale of Cisco. So Cisco hit its peak in 2000, but it traded at an extremely rich valuation at that time. And in the 24 years since, Cisco has continued to be a very strong company fundamentally. It's grown earnings by about 10 times, but the stock still sits about 40% below those all-time high prices set in 2000. So generally, valuations are poor timing tools, and they really don't matter that much, except for when you get to extremes. Now, the Elite 8 are no doubt pricey today. So if we're going to focus on overweighting certain areas of the market, we want to consider areas that have a cheaper valuation, and we'll get to that in a second. But just one more point on the bull market and why we have some conviction that it's not done yet. Here in this chart in orange, we're showing the percent of stocks that trade above their own average price of the past 200 days. We want to see relatively high readings in this indicator because it means that a large percentage of the individual stocks that make up the market are in uptrends. Now, you typically see market participation peter out well in advance of a bull market top. Instead, in the first quarter, we actually got better participation. Now, that's a good sign from a technical perspective. Does it mean we can't have corrections along the way? Certainly not, but it likely buys us time for this overall bull market. And in fact, we sort of expect a correction right now. The market was up in every month of November through March, 5 straight up months. So it's likely a little overbought here, and sentiment is probably a little too optimistic. But here's a study that shows every other time in history that the market gained in each month from November through March. This is going to be tough for you to see because there's a lot of numbers on this table, but the big takeaway was that 9 months later, or for the rest of the year, the market was up 12 out of 12 times for an average return around 12%. So we expect that the uptrend is going to slow down, but we expect it to persist in 2024. So we're currently overweight stocks in our investment strategy. Okay, so if we're not going to look to the big Elite 8 stocks to overweight, what should we be looking at? Well, small cap stocks are getting a pretty interesting setup right now. So here in the top clip in dark blue, we're showing small caps relative to large caps. If the line is falling, that means that small caps are underperforming large caps. And if the line is rising, that means that small caps are outperforming large caps. Well, it's been falling more of late. And that's really what's happened over the last few years. And here lately, small cap performance versus large cap has been more negatively influenced by rising interest rates than anything else. So that's what the bottom clip in light blue is telling us. It's telling us that relative small cap performance is typically positively correlated with interest rates, but now it's actually negatively correlated with interest rates. So rising rates this year have been a headwind for small caps. But like we noted earlier, we don't think the Fed's going to hike rates again. So what that implies is that rates are likely capped. They're only going to go higher if the market believes that the next move is not a rate cut, rather it's going to be a rate hike. If interest rates move lower from here in the rest of the year, that could be a positive development for small caps. And what's been interesting is that small cap fundamentals look like they'll finally start to improve. Here in the top clip in blue, we're showing analyst estimates for earnings in the next 12 months for large cap companies. Analysts expect about 11% earnings growth from large caps. Now, in red in the bottom clip, we're showing analyst estimates for small cap earnings, and it's currently at 7%, so less than large cap. But the important thing is that they're being revised higher at a rate faster than large cap companies. Now, remember that we mentioned earlier that the economic environment is improving for large cap earnings. Well, that same improvement is likely to be even better for small cap earnings. Improving fundamentals could be a great development for small caps. So here in this chart, what we're showing is that same Ned Davis earnings model in orange, but instead of large cap earnings in the top clip, we're showing small cap earnings. And you can really see how much pressure small cap earnings faced in the last 2 years here. But note that under the current economic environment, small cap companies have tended to grow earnings at a very strong 22% annualized rate. So there are certainly some pieces that are starting to fall into place here for the small cap companies. We're overweight that asset class currently. Okay, let's move on to some election perspectives. So the 2024 election is a redo of 2020. So there are, of course, going to be some similarities. Despite those similarities, this election is unique in a number of ways. So some statistics that were kind of interesting that came to us from our friends at Ned Davis. Not since 1968 and Nixon has a candidate lost the general election and then went on to win a future primary. Two candidates haven't had a repeat matchup since 1956. Those were Stevenson and Eisenhower. And this is the first time since 1892 and Cleveland that a president lost the general and was nominated by the same party to rerun against the same candidate that they had lost to. Neither candidate is proving very popular from a general electorate perspective. So perhaps unsurprisingly, a recent poll found that nearly 60% of voters do not actually want to see this replay. But our job is certainly not to opine on politics, but rather wade through policy to determine if there could be an impact to portfolios. So let's start with the broad market. First, election years tend to have a positive bias. The market tends to follow a pattern of monetary and fiscal stimulus. Perhaps unsurprisingly, stimulus tends to ramp up in that pre-election year and maintain a positive trajectory for most of the election year. Now, the orange line here plots the average policy mix through an election year. Thus far, the policy mix has been more neutral, but easing by the Fed or additional fiscal stimulus later on in the year, that could change things as the year progresses. Now, maybe one of the more surprising statistics for listeners is that market leadership has been very similar under both Trump and Biden. The orange bars here show each sector's relative performance under Trump, and the blue bars show relative performance under Biden. Now, tech has been a big winner under each, and relative safe havens like utilities and consumer staples, those have underperformed under each. Now, the big difference really has been energy and how energy interplays with consumer discretionary. Now, Trump was favorable to the energy sector from a deregulatory perspective, but perhaps that's a major reason that there was a flood of oil supply on the market, which inevitably pushed energy stocks lower as the commodities themselves fell. And energy was a huge underperforming sector under Trump. Now, under Biden, who has been much less favorable from a regulatory perspective, energy's been a big outperformer. The commodities themselves have been rallying, and that's boosted the share prices for energy stocks. Now, the interplay between policy and performance is complex. I think the key here is policy matters, but other factors can overwhelm policy considerations. So let's talk about some areas that our partners at Ned Davis are watching from a policy perspective. One area to watch may be defense spending. Under Trump, the defense budget generally grew, and under Biden, and post-pandemic, spending has really shifted to other areas. Now, in the next 4 years, given rising geopolitical tensions and a potential shift to a multipolar world, defense spending may come up regardless of who's president. But historically, it has risen more under Republicans than Democrats. More government defense spending has perhaps unsurprisingly been a bullish development for industrials, and particularly the aerospace and defense stocks. Now, another area to watch is healthcare, and particularly the pharmaceutical industry. Now, this may come as a surprise, but under both administrations, drug prices they've risen much less quickly in either regime than the regimes before them. And that's what we're showing here in orange, is prescription drug inflation relative to broad inflation. Of course, that doesn't mean that drug pricing has fallen outright. It's just that it's gone up more slowly than other inflation areas. Now, what's interesting from an investment perspective is that when drug prices have risen slower than broad inflation, the pharmaceutical industry has actually performed quite well. And that's because these companies aren't as much of a regulatory target when drug prices aren't rising as quickly. Now, healthcare could do well in the next 4 years just due to less attention, as the electorate has very clearly shifted in what they rank as their top policy priorities. Now, finally, we've not seen regulation really bite the tech titans yet. Large tech companies, they've been dominant under both presidential regimes. It'll certainly be interesting to follow along with either candidate's platform around tech regulation and how that evolves. As we stated earlier, valuations are pretty rich for a lot of these big tech companies, so the extent to which they can avoid major regulatory burden in upcoming years is likely to be impactful for these stocks. Okay, so thanks for hanging in there with me for this update. There's obviously a lot that we didn't touch on that's going on in the world, but remember, there quite literally is always a lot going on in the world. We like to focus on economic trends, market developments, and corporate fundamentals. Now, to that end, to recap, we're likely in a bull market until the next recession is closer. Fundamentals are improving and likely to continue to do so through this year. Now, from an election perspective, election years have tended to be strong because there's been a positive policy mix. This year has been more neutral, but could become more stimulative in upcoming months. And for some more granular themes that we'll track in upcoming years, defense spending, drug pricing, and tech regulation, those are going to be some things to watch. Now, if you're interested in more regular updates from us, you can catch our timely short audio casts at noon on Mondays, and we'll continue to offer these in-depth quarterly reviews throughout the year. For any additional information and/or questions that you might have, please contact your advisor, and we'll be happy to help. Thanks for tuning in with us today.